This is David Field, Manager of Carmignac Commodities here at Carmignac. We've received a number of questions from our clients concerning the outlook for commodities, and today I would like to answer some of the most common. We think we are in a long-term secular bull market for commodities, meaning that it's a good place to invest your money not only for the next 12 months, but for some years to come. We are at a very unique point in human history. In 19 out of the last 20 centuries, China has been the world's largest economy. The 20th century is in fact a historical anomaly, driven by the fact that the Western economies simply modernized and industrialized their economies ahead of China. China is only now beginning that process, which is very metals and commodities intensive. We have seen periods in the past, if you look here on this graph, where these industrialization and modernization trends have driven above trend pricing and above trend growth for a number of commodities. You can see it here for copper in the 1920s with the industrialization of the US, and in the 1960s with the post-Second World War modernization of the Japanese economy. We also feel that this is a process that is just beginning. If you look at China's growth path compared to some of its near neighbours like Japan and Korea, we still see that they have a long way ahead of them before they reach the same levels of consumption of commodities that these economies reached. So we think we are looking at a period of 5+ years of very strong commodities demand growth in China. We remain very bullish on gold for the medium term. Traditionally, there is a very high correlation between the gold price and global liquidity, usually through the mechanism of inflation. Today's very reflationary fiscal and monetary policies, both in the US and elsewhere around the world, to us is very bullish for the gold price in the medium term. In addition, in the last quarter of 2009, there was a very significant new development. The Indian Central Bank purchased 200 tonnes of gold from the IMF. Central banks have been net sellers of gold since the early 1990s. So if this represents a change in that behaviour towards becoming closer to net buyers, that has very significant positive implications for the global supply-demand balance for gold. To put it in perspective, if China, whose current reserves are about 1.5% in gold, went to just 5% of its reserves in gold versus a global average of more than 12%, that would take every ounce of gold that's been produced in the world for just on a year. In addition, the gold price remains well and truly below its inflation-adjusted peak, which gives us a great deal of confidence that the gold price can move higher from here. One area we've become much more bullish on in early 2010 are the bulk commodities involved in the production of steel. That is to say, coking coal and iron ore. In the coking coal market, until the end of 2008, China was a net exporter of coking coal. However, in 2009, in an effort to improve both the size and the safety record of their coal industry, China closed a number of their smaller mines. The net result of this was, in coking coal, they went from being a net exporter to a large net importer of coal. This is very good news for the overseas producers of coking coal, as it represents a very important inflection point in the market and an improvement in their bargaining position. We've seen the results of that in the recent settlement that BHP announced for the first quarter of 2010, where they achieved a 55% price increase over the contract price in 2009. We also have high hopes for the iron ore market. When we look at the iron ore market at the moment, spot prices are around 80 to 90% higher than the contract price that was negotiated last year, which we think puts the iron ore producers in a very strong bargaining position again. In addition, we like the structure of this industry very much, where 60 to 70% of seaborne iron ore is basically produced by 3 companies, Vale, BHP and Rio. And again, we think that gives them a very good position versus the steel makers who are much more diffuse. The final good positive point is when we look at the Chinese domestic iron ore industry, it's generally very low quality iron ore, which means it takes a lot of processing costs and a lot of mining costs to produce a usable product for the steel companies. What that means is they need a very high price in order to cover their costs. and that again is very good news for the overseas producers like Rio, who have much lower production costs. So in conclusion, we think there are a number of reasons to remain bullish on commodities for some years to come. China, the world's most populous country, is joining the Western world in modernising and industrialising its economy. This very commodities and metals intensive process will drive above trend pricing and demand growth for a number of years from this point. There are a number of ways to benefit from this, but in particular we think the metals and the bulk commodities will be strong beneficiaries, and we also think gold will have a strong performance, driven more however by the very reflationary policies that we're seeing in the US and other Western countries around the world. Thank you very much for your time.